So where does the private equity come from, and when do investors get the return?
Firstly, I mean, just to distinguish what we do and what private equity does, just a couple of terminology things, if I may. One is private equity can be seen as a process, right? And I still recall there's a book, I think one of the guys out of Bain Capital, if I recall correctly, had written about saying, well, you know, any company should follow and can follow what private equity does. Okay, so that's one thing, and that's a sort of kind of a process view or a kind of a professional view. Then there's the whole area of private equity as a industry and as an asset class, you could call it that. There are different asset classes in the world of investment, and there's an asset class that is commonly referred to now. There's alternative, which includes hedge funds and also private equity. And private equity, in essence, what they do is they create normally a fund, and they raise money through that fund, and then they invest that fund by acquiring companies, increasing their value and selling them and providing a return to their investors, basically. And they have different kinds of strategies in private equity, and most of them tend to specialize within, for example, the buyout, as it's referred to, because normally they buy out the owners. There could be, for example, a strategy around distressed or turnaround when a company is really in trouble, and there's specialists that go into that. There's a whole part of the market that's more focused on growth. For example, there could be, and there is an area that we're more involved in, which is that they call as mid-market, which is a segmentation based on size. So that's the whole private equity industry. What we do is, if you think about the private equity industry, let's say, if you look at those that target smaller companies, which in the UK we refer to them as mid-market, you know, if you look at the size of investment that they make, because they have sort of minimum values, right? They tend to, you know, it depends on the actual, you know, private equity firm. They sometimes don't come below around 5 million worth of valuation. Sometimes they come a bit less, right? We're basically targeting just the area underneath that, and that's what we do. And when we looked at that, we thought, well, you know, you need to have a different way of approaching this. And I actually did, it's interesting, at the university, I did my own research when I was at City University in London, on, you know, the whole funding gap issue for small companies, right? And we actually were supported by the British Venture Capital and Private Equity Association. And I actually interviewed some of the PE houses, and my conclusion was the model and the kind of, let's say, infrastructure that private equity firms has some restrictions in terms of their ability to target this smaller end of a segment. So the way we're approaching it, to answer your question, how does it work? We view it in line with the platform model that a lot of technology companies have taken. And if you look at the precedents for what we're doing in Australia, there are a couple of, I'm sure you guys have heard of the crowdfunding platforms. Have you? Yeah. So if you think about, yeah, those, and that's a platform, right? So let's use that as an example. They do, crowdfunding does equity, which is shares, right? So it's not loans. So they do equity, but for startups. Yeah. We do equity, but for established companies. So they're older. And our target market, I think we'll talk about this later on, are sort of 20 to 10-year-old companies that have a track record and a very specific industry. So our model, in terms of how it works, is a platform model. Our participants in that platform are small companies. Investors, we don't go, and this is one of the distinguishing factors, we don't go to retail investors. So we don't go to a lot of, you know, the public to say, hey, do you want to invest in these small companies? Unlike crowdfunding, which does, right? We go only to professional and institutional private equity investors, and only a few of them. And they're very specialized and have a very specific investment criteria. So they're the investors, we have the small companies, and there's a third group who are the professionals that are normally involved in let's say, the due diligence and the value creation that the industry refers to, tend to be accountants, lawyers, marketers, and so on. So they're the three main groups that are involved in that platform. And like any platform model, we connect them, basically. Our model is also not a very high volume model. Our model is high value, because in essence, the kind of activity, although we're not a bank, historically these kind of activities have been more in the investment banking kind of the bank, in contrast to, I'll give you another example of a platform which it is peer-to-peer lending platforms. I don't know if you've heard of those.
Yep.
They're also small companies, which is like us. Yeah, we're small companies, but they do debt, right? So lending. Yep. Yeah. So and those lending guys are high volume normally, and it's more consumer banking historically, part of the bank, if you compare them to what banks do.
All right, great.